Okay, so easy for those of you who are interested in my musings. Uh, the easiest way to follow me, I write almost all of my writings are based upon academic research findings. I write for 4 websites, so it's easiest to follow me at Twitter at Larry Swedroe. Every time I post, I just put up a short tweet, and then you can follow it. But I write for Seeking Alpha. I write for Advisor Perspectives, for Alpha Architect, and for those of you who are what I would put in the geek category, interested in really the science of investing and like to read academic papers, which could be dense, 50, 70 pages type of stuff. Alpha Architect is by far the best site. And the 4th site I write for is Evidence-Based Investor. All but Seeking Alpha, I think, are great sites. Seeking Alpha is more of a, I don't know what the right words are, those trying to hit a lottery ticket or whatever, chasing returns or stuff. I'm sort of the antichrist there. I'm the opposite of everyone else on that site. But you can follow me simply at Twitter at larryswedroe.com. And for those of you who are not aware, anyone who reads my books, I'm always happy. My email address is there, and I'm happy to answer questions from readers. So with that said, this talk is about the incredible shrinking alpha. Before we go into it, I'll provide a few definitions to be helpful. First is that alpha is the return above the appropriate risk-adjusted benchmark. So if you invest in the S&P for the last 90 years and you got 10%, that 10% is not alpha. The roughly 7% excess over T-bills isn't alpha either. That's a return for taking risk called market beta risk. Now, if you have a market beta of 1, which the market does, then you have maybe alpha. If you invest in small stocks and they beat large stocks, that's not alpha. That's taking more risk. Or if you invest in emerging markets and it outperforms the US, that's not alpha. Now, if you outperform an emerging market index, that could be alpha. So that's definition 1. Definition number 2 in academics literature, a factor is an easy way to think about it is nothing more than a trait or a characteristic. So a factor are small is companies who have smaller market capitalization. Value is it sells cheap relative to some metric, whether it's earnings, book to market, or whatever. And the premiums are always determined by the following. They are long-short portfolios, so market beta is the return on stocks minus the return on T-bills. Value is the return on value minus the return on growth. Size, return on small minus the return on large. And they are always, by convention, annual average premiums, not compound returns. So don't confuse them. A simple example, stocks on, if you took the last 90 years, you get about 12%, and T-bills are 4, roughly. So you get a risk premium of 8. But annual averages, because volatility destroys returns, and volatility is much higher for stocks than T-bills, the annual risk premium for the annualized compound difference is more like 7%. So you have to be careful to make sure you are using these definitions properly. So with that said, hopefully that will be helpful. So we're going to begin here with, coincidentally, in 1998, Charles Ellis writes his much more famous book than my first book, which was let's see, what was it? Your oh my God. Well, whatever the name of the book was, and you're a guide to your guide to the winning, and your complete guide to the winning investment strategy, or something like that. Charles Ellis, literally almost the same month, published his much more famous book, Winning the Loser's Game, in which he presented evidence that while it's possible to generate alpha by and win the game of active management, the odds of doing so are so poor, it's simply not prudent to try. And just like at the crap tables, the roulette wheel, and the slot machines in the casinos in Las Vegas, the surest way to win that loser's game is simply not to play. And investing, that means investing in passive strategies or index funds. Now, there's lots of, I'll give another definition just to be clear here. I'm going to define passive investing as anything that defines its universe and then systematically invest in it. So you don't, index funds by definition are passive then, but there's no stock picking and no market timing. Those are my two criteria. But if Mary Chandler created a fund that was the top 10 stocks equally weighted, and when a stock left the top 10, she wouldn't sell it unless it was a loss, and then she would buy the new 10th stock until it became equally weighted using cash flows, etc. Clearly, no stock picking, no market timing, but there's no index of top 10 stocks equally weighted, rebalanced with cash flows. So index funds are only one version of passive funds. Most what are called, and I hate that term, smart beta, most of that is an oxymoron. It's just beta, nothing smart about it. But most of the ETFs, for example, are passive, even though many of them may not be index funds. So today, with that background, I'm going to explain why the case against active management has been getting persistently stronger since I began writing now 22 years ago when my first book was published, and continues to get stronger. Let's see, why is this not going forward here? Let's see. Well, I'm going to have to try it this way. I don't know what the problem is, but all right. So we'll discuss four big themes here behind this, what I think is an inexorable trend, that the academic research has been converting what was once alpha into beta, the pool of victims that are needed to be exploited. If somebody's generating alpha, somebody's got to have negative alpha, because before expenses even, outperforming the market is a zero-sum game, because if I outperform by owning Tesla, somebody underperforms because they underweighted Tesla. The third is the competition is getting tougher, and the supply of dollars chasing alpha has increased. We're going to begin our story with the history of asset pricing models and the important role they play in this story. So building on the initial work of Harry Markowitz, John Lintner, William Sharpe, and Jack Traynor, we're generally given most of the credit for introducing the first formal asset pricing model, the CAPM. It was developed in the early 60s. Now, the CAPM provided the first precise definition of the relationship between risk and expected returns. It was also important because it allowed us to understand whether an active manager who outperforms the market has generated alpha, or whether their outperformance could be explained by exposure to some factor, in this case, market beta. Now, this is an important issue because alpha is clearly a scarce resource. Active managers are able to charge relatively high fees for at least the promise of alpha. However, if the outperformance can be explained by exposure to a common factor or trait or beta, which, by the way, beta just means the amount of exposure you have to a factor. It's commonly confused with market beta, which is the market's level of risk, and we'll talk about that. So if you're paying high fees for alpha and you're really having exposure to beta, then you're paying this high price for beta, but you're actually receiving just nothing more than loading on a common factor, which could be obtained in a less expensive manner using today certainly low-cost vehicles such as index funds and ETFs. So the CAPM looked at risk and returns through a one-factor lens, meaning the risk and the return of a portfolio was determined by its exposure to beta. Now, beta in this case, or market beta specifically, is the measure of the equity type risk of a stock, mutual fund, or portfolio relative to that of the overall market. Now, so in other words, if your portfolio or stock is riskier than the market, it might have a beta of 1.2. If the market went up 10%, you should go up 12. And if you only went 11, then your alpha was negative, even though you outperformed the market. On the other hand, if you own some defensive stocks like grocery stores or Walgreens or utilities, they may have betas of 0.6. The market goes up 10, you go up 8 when you should have expected to go up 6. Even though you underperformed the market, getting 8, not 10, you generated alpha because you outperformed the appropriate benchmark, okay? So that's important to understand. Now, the CAPM was the finance world's first operating model, and it lasted for about 30 years. This was a major innovation. In fact, I was one of the first people in the late 60s to get a degree in finance even, because there was no financial theory before that. If you were taking finance classes, it was either in an economics area or in an accounting area. And in 1972-3, when I went for my MBA, was one of the first MBAs in finance. So it was the world's first operating model for about 30 years, mid-60s to the early 90s. However, like all models, by definition, they're flawed or wrong. They're not like cameras that provide us with perfect pictures of the world. If they were perfectly correct, like a camera takes a perfect picture, then they would be laws like we have in physics. Instead, they are engines that advance our understanding of how the markets work and how prices are set. So you want to think of them as engines, not perfect cameras. Now, the CAPM was able to explain about 2/3 of the difference in returns of diversified portfolios. So let's say Mary owns 100 stocks. I don't need to know their names. Just tell me what their market betas are, and I will predict their returns. Suzette owns 100 different stocks. I don't need to know their names. Just tell me their betas, and I'll predict her returns. Now, let's say Mary's portfolio gets 10% and Suzette's gets 13. The CAPM was able to explain 2 of that 3%, or 2/3. The other 1% might be that Suzette was a better stock picker, more skilled. It might be that it was just purely random luck, or it might be some undiscovered yet factor that could have increased the explanatory power of the model. Now, over time, anomalies began to come to the front, and academics began researching them. So about 15, 16 years later, Ralph Bands, in his famous paper, found that market beta didn't fully explain the higher average return of small stocks. And so small stocks had higher returns than large stocks, even after accounting for the fact they had higher betas. And around the same time, a series of papers were published that showed that market beta didn't explain the outperformance of value stocks either. So in 1992, the most famous paper probably in all of finance, I think it's still the most cited paper, the cross-section of expected returns by Fama and French. They summarized all of these findings. They didn't discover anything. And they don't take credit for discovering anything, although a lot of people give them credit. All they did was summarize the research in one place. They proposed that along with the market factor of beta, exposure to these newer factors of size and value help explain the cross-section of expected stock returns. Now, this Fama-French model, 3 factors, improved the explanatory power from about 2/3 to more than 90%. In that example where Mary got 10 and Suzette got 13, and we were able to explain with the CAPM 2 of the 3, we're now up to, let's say, about 2.75%, leaving not much room for either luck, skill, or any other factor, which means that the odds of active managers being able to add value when their expenses are a lot more in that example than the 25 basis points, we're getting close to 0. And this was a revolution in finance that changed the way people began to think. Now, hopefully everyone's going to remember, so I don't have to go through these definitions again, but over the period from 27 to 19, so that's 93 years, these are the annual average premiums to these long short factors. So as an example, beta, the total market on an annual average basis had higher returns than T-bills of 8.6. Small stocks beat large stocks, annual average 3.1, and value by 4.5. Now, prior to the development, and this is what's important, of the 3-factor model, actively managed funds could outperform a benchmark such as the S&P simply by having more exposure to these size and value factors than the benchmark. S&P has no exposure to the size and value premiums. Now, I'll take a moment to be helpful and help. This confuses a lot of people, so I'll divert for a second. People say, Larry, if I own a total market fund, don't I have exposure to the size factor because the market owns about 10% small stocks? And the answer is no, because the size factor is a long-short portfolio. So think of it as the large stocks you own is like digging a hole in the sand at the beach, and then you add back the 10% small stocks and you fill up the hole and you're back to a flat beach, so you have no net exposure. And the same thing, even though the total market owns 20% or so of value stocks, the 80% that you own that are growth stocks are that hole in the sand, and the 20% that you own of value just refill the hole. So even though the market owns exposure or owns small and value stocks, it has no net exposure to these unique factors. So what's important is that before 92, if I beat the market by owning these smaller value stocks, I could claim alpha, and rightly so. After 92, I can't do it anymore because a simple regression analysis would expose my lie. And so these 2 big sources of alpha just disappear. Now, it's important to understand this takes nothing away, for example, of Warren Buffett, who for 60 years had been buying value stocks. He discovered the secret sauce decades before the academics did. And it takes nothing away from those who are buying smaller stocks and outperforming either. But what it does do is it now says you can't claim alpha by getting exposure to this, because I could get that same exposure by owning very low cost ETFs from Vanguard, Fidelity, or whoever else you want. So that's important to understand. Let's go. So then it takes, we get about 5 years later, Mark Carhart writes a paper and adds the next factor on momentum. And he showed that stocks with positive momentum added value, added explanatory power of the model. It upped the model's explanatory power from the very low 90s to about the mid 90s. And the momentum premium was a massive 9.1%. Now, it's important for everyone to understand these premiums are not really realizable because there are no transactions costs in there. Even market beta, you could not have earned 8.6%. You'd have some trading costs today. Even Schwab's funds, I think it's 1.5 basis points, and there are some trading costs. So you're going to underperform by a little bit. And momentum is by far the highest turnover. You could never have got 9.1% because turnover in that fund would be over 100% a year. So you have to keep in mind these are pure paper portfolios. And while the size and value premiums are much closer to what is realizable because turnover is much smaller in the 20 to 30% range, it's still, you could not capture 100% of the premium. But again, it's important to understand here, anyone who was gaining, outperforming the market by gaining exposure to stocks that had recently outperformed could claim alpha before 97. Now you can't do that anymore. But again, it doesn't take anything away from those people, but you can't do it anymore. Every single one of the funds that my firm uses not only all of these factors, but they use the next factors as well that they're going to touch on. Took 15 more years. Now, you remember, we're up to about 95% explanatory power. So if you think in that example of 10 and 13, that's 3%. There's only about 5% left. That's 15 basis points in that example. Even if I find something more, it's not going to help that much more. But took 15 years, and the academics came up with something Buffett had been telling people for decades. Robert Novi Marx in his June 2012 paper, The Other Side of Value, the gross profitability premium, provided investors with new insights into the cross-section of stock returns. He found that profitable firms generate higher returns, about 3.7% a year at that time, than less profitable firms, despite the fact that they had significantly higher valuations. So controlling for profitability improved the efficiency of a portfolio. Now, this idea has since been extended to a quality factor that captures a broader set of factors. And once again, alpha, or a source of alpha, became beta. A good explanation and demonstration of this is from the 2013 paper, Buffett's Alpha. Now, the conventional wisdom is that Buffett's success is explained by his stock picking skills, and also obviously his ability to keep his head while everyone else was losing theirs. However, this study provides us with some very interesting and unconventional answers. The authors found that in addition to benefiting from the use of cheap leverage provided by his insurance companies. So you and I buy insurance from Buffett, and he gets that premium, and he may not pay out on it depending upon the policy for decades. That's free leverage in effect. And once we account for that and the fact that he bought stocks that were safe, cheap, high quality, and large in general, all of his alpha virtually disappears. Not quite 100%, but pretty close to it. So Buffett was buying stocks with these characteristics. And if you buy these stocks with these characteristics, you would have dramatically outperformed the market. What this paper found, that it wasn't Buffett's stock picking skills, because if you bought every stock, you create an index of stocks with this, you would have basically matched the return of Buffett. That came out in a study called Betting Against Beta. Now, what's really important for you to hear is that this takes nothing away from Buffett's performance, because after all, it took decades for modern financial theory to catch up with him and discover his secret sauce. However, the findings do provide us with insights into why he was so successful. It was strategy and not stock picking. Buffett's genius, therefore, appears to be in recognizing long ago that these factors work, applying leverage without ever having to fire sale, and most importantly, sticking to his principles. Buffett himself stated in a 1994 annual report that Graham had taught him 45 years earlier that investing is not necessary to do extraordinary things, to get extraordinary results. Just follow these simple formulas. So, again, today, every one of the funds we use basically screens for these characteristics. We're now going to turn our attention to the world of bonds, and just as we have factor models for bonds, we have for stocks, we have them for bonds. Here it's a much simpler. We have two factors. You can see them here, the term premium, default. Now you'll note the default premium, which is calculated the return on long-term treasuries versus the return on long-term corporates before expenses, is virtually zero. Now, treasuries you can buy on your own at zero expense. If you're going to buy corporate bonds, you better be diversified, so use a fund. Even Vanguard's fund might cost, let's just round it to 20 basis points. Trading costs will get you maybe another 20. You got no premium, it's gone, which is why we don't buy we don't buy corporate bonds or recommend anyone else buy them either. There's really little to no evidence you've been rewarded, and the problem is that their correlation, even of investment grade bonds, while relatively low to stocks, the correlation turns positive at exactly the wrong time, while with treasuries they turn negative. But there is a term premium, and we can see that here. So if you, before this model was created, you bought longer bonds, say in 1980, and then you claim alpha, well, you can't do that anymore. In this year you bought long bonds, you can't claim alpha, because I could buy an index of long-term treasuries. And these explain the vast majority of returns now of bond portfolios. The bottom line is that these factor models have not only advanced our understanding of what drives the risk and returns of portfolios, but they also enable us to separate alpha from beta. And that allows you to avoid paying the high fees of active management for delivering what is nothing more than his exposure to a common trait. We're now going to turn our attention to some really interesting issues, which is that the first one being that for some investors to generate alpha, they have to find victims to exploit. William Sharpe wrote a famous paper, The Arithmetic of Active Management, in which he showed if the market gets 10%, I own Vanguard's total market fund. Before expenses, I get 10%. Since all stocks have to be owned by somebody, in aggregate, active investors have to get 10%. But since they have higher expenses, in aggregate, passive investors must get higher returns. And any study that purports to show otherwise, basically something is likely wrong with this. Now, the question then is, if some active investors are going to outperform, which of course some can. That just means lots of others underperform. They need victims to exploit. Exactly who are these victims? Well, it turns out it's people like you on this call, naive, or what parochially is called dumb retail money. The research shows, and there are dozens of studies all finding the same things, that the stocks that individual investors buy on average, they have perverse stock picking skills. They buy stocks that go on to underperform, and they sell stocks, and they sell stocks that on average go on to outperform. Now, obviously, someone's on the other side of the trade. It turns out it's sophisticated institutions. The problem is, and we'll talk more about this in a minute, is that the stocks that they buy do beat the market. As one study found, they outperformed by about 70 basis points. The problem was it cost them over 200 in trading costs, expense ratios, market impact costs, the cost of sitting on cash, all added up, so they dramatically underperform after all their expenses. All right, so that's important to understand. So it's the institutions even end up with negative net alpha. So here's what's important out of what I just told you. Just as economic theory predicts, what economists call the economic rent is going to the scarce resource, which is the ability to generate alpha, not to the plentiful resource, which is capital. So the stock pickers on the institutional side beat the market by 70 basis points, but the retail investors in those funds got negative alpha. Who captured the excess returns? The sponsors of those mutual funds. They were the only winners in that game. Importantly, these trends that are working against alpha, against the active investors, is that the pool of victims is shrinking as there's been a dramatic decline in the fraction of stocks owned by individual investors. Coming out of World War II, 75 years ago now, 90% of stocks were owned by those dumb, naive retail investors, owning those securities, holding them in their individual brokerage accounts. So lots of victims for Warren Buffett to exploit. The odds were if he traded, 90% of the time, the person on the other side was some naive retail investor. Who's likely to win that game? We know the answer to that. Or if Goldman Sachs or Morgan Stanley was trading, likely they're the winner. They have more resources, more information, more training, etc. Today, that number has collapsed. By 2008, it was down to 20%, and the number has kept shrinking. And today, we're now up to about 50% of institutional money even is now passive. And that's meaning that the pool of victims is shrinking rapidly. And on top of that, the next theme, our third one, is the competition that remains is getting tougher. Let's see why that's the case. So it seems likely to me that those abandoning active management will be investors who had poor experience with investing. Obviously, if you're beating the market, you're going to take credit for your brilliant strategy. You'll never attribute it to luck, likely, and you're going to keep playing. So the ones who are leaving the game are the ones who said, hey, I tried, not successful, I'm going to give up and abandon it. I'm just going to invest in index or other systematic strategies. So that means that the competition has to be getting tougher because the less skilled players are leaving the field. Think of it this way. Roger Federer, greatest player probably in the history of tennis. Think about him in the first round of a Grand Slam tournament. He's playing not against the average weekend player like me like Buffett might compete against me when he trades. He's playing against one of the top 128 players in the world. And yet he never lost a first round match. Clearly, the difference in skill between Federer and his opponent was dramatically smaller than the difference in skill between Buffett and Goldman Sachs and the average retail investor. Yet Federer never lost the match in the first round. As he advanced, by the time he got to the quarterfinals, I don't know, but maybe he lost 25% of the time playing against one of the top 16 players. Then he got to the quarterfinals, he'd be at 8. So maybe he lost 25% against the top 8 players. Semifinals, he's playing likely against the top 4 players in the world. Maybe he loses 35% of the time. And the finals, maybe he's playing the second best or third best player in the world. Maybe he lost 40% of the time. So his odds of winning, still he was favored, but his odds of winning decreased because the competition was getting tougher. What's happened in the field of investing today? Well, I'm going to tell you that the competition has gotten dramatically tougher. When I got out of school with an MBA in '73, most of the people who were analysts, stocks, were some English major, some university, because there weren't even finance programs. They went and got trained maybe, and they were there to pick stocks, etc. Today, there are legendary hedge funds like Renaissance Technology, SAC Capital, D.E. Shaw. They hire world-class scientists armed with the best computers, the fastest tools, and not only mathematicians, but computer scientists, MBAs from the top schools such as Chicago, Wharton, MIT. They're flocking to these firms armed with the most powerful computers, massive databases. So just an example, DFA's CIO, Gerard O'Reilly, has a Caltech PhD in aeronautics and applied math. Andrew Birkin, the co-author of my book, The Shrinking Alpha, and he's the director of research at Bridgeway Capital. He has a Caltech BS and University of Texas PhD in physics and is a winner of the NASA Software of the Year Award. The unsurprising result is that after costs, it's becoming more and more difficult to win the game of active management because the remaining competition is getting tougher and tougher. And as that first group, just like Federer, in the first round, 128 players, the next round, he's playing the top 64. Well, as active managers individuals are abandoning the game, and the active mutual funds that are closing because of poor performance, they're leaving the game. They were the least skills. It's like now, 20 years ago, they were like Roger Federer in the first round, and now we're down to the quarterfinals. The competition has simply gotten much tougher. And we're going to see the impact of that increasing competition, how it plays out in the world of baseball. To give you an analogy, to me, this is really fascinating. I hope you find it as fascinating as I did. So baseball's modern era begins in 1903. Prior to that, a foul ball that wasn't caught was not counted as a strike, giving a tremendous advantage to the batters. From 1903 then, from 41, the modern era, so that's 39 years, 7 different players, 12 times a total, hit more than 400. The last National Leaguer to do it was Bill Terry in 1930. That's 90 years ago. The last American leaguer to do it was this gentleman, the splendid splinter, Ted Williams, 1941, 79 years ago. He hit 406. So it's been now 79 years since anyone has hit 400. Yet today's baseball players are clearly superior athletes. They're bigger, faster, stronger, use superior training techniques, superior diets. Some would argue they use superior pharmaceuticals. And that presents us with this seeming anomaly that how come these great athletes aren't able to achieve even once in 79 years what was accomplished 12 times in the prior 39 years? Now, part of the explanation is today's athletes are also pitching and playing defense, and they have superior equipment. On the other hand, the strike zone has gotten much smaller, right? That's giving hitters a big advantage. And the outfields are pulled way in. It was not uncommon in the 20s for a center field to be 430, 450 feet away. And today, their typical center field is maybe 406 feet away. So the answer of why this has happened is called the paradox of skill. So I'll explain it. In many forms of competition, such as chess, poker, tennis, or investing, it's the relative level of skill that plays the more important role, not the absolute level of skill. That paradox means that as the skill level rises, luck becomes more important in determining outcomes if the level of the competition is also rising. The result is that the average skill increases. It's more difficult to outperform by large margins. Think of Federer. In that first round of a Grand Slam, he'll often win 6-1, 6-2, 6-0. By the time he's in the finals, he's playing, 6, 7, 6 matches and going into sudden death to try to win in 5 sets. So in other words, the standard deviation of the outcomes are narrowing. So let's look at the statistical evidence in baseball. In the first 2 decades of the modern era, the average hitter hit between 250 and 260 every year. During that period, the 400 mark was reached 4 times or once every 5 years. Since then, the average batting averages remain persistently roughly between 250 and 260. That's because I think the owners have recognized that presents a good balance between offense and defense. We don't want to get like in 1968 when Bob Gibson set the record with a 1.13 ERA and Carl Yastrzemski led the American League with a batting average of just 301. Games were much more boring at 1-0 or 2-1, which is okay once in a while, but not all the time. So the owners shrink the strike zone when the pitchers get more dominant. If that continues, they lowered the mound as they did in 68 to even it. Then they pulled the fences in, and they keep changing it to try to keep that batting average there. So in 1921, the end of that period that saw a 400 batting average about once every 5 years, the standard deviation was about 41 points. So a hitter today, the standard deviation, let me say by 2003, it was already down to just 26. So if you have an average batting average of 260, by 2003, hitting 400 became more than a 5 standard deviation event, which meant you had less than a 1 in 1,000 chance of hitting 400. In other words, when Babe Ruth and Ted Williams were playing, there were batters hitting 380, 390, and an occasion 400, but there were also a lot of hitters hitting 180 and 190, and you had an average of 250, but there was a wide dispersion of outcomes. Today, you have the average is still 250, 260, but the best hitter may only hit 330 or 340, and the worst hitters now may be hitting 210 or 220. You don't have that wide dispersion of outcome. Now, if that theory of the paradox of skill is true, we should see a decline in the standard deviation of active managers, and this is exactly what you see in this study with a little blip because you had a massive dispersion due to the tech bubble. If you owned the tech stocks in that period, you massively outperformed. But look how the average standard deviation collapsed from about 13% in 97, getting down to about 8% by the end of the period. Now, another study on the same subject looked at 3 categories. This was done by a pension plan consultant. They divided active managers into 3 categories. Those that were generating no evidence of statistically significant alpha. Now, if markets are efficient, you would expect most to be there. And that number for the last 30 years has wandered right around 82% by the time that study ended. Now let's look at the unskilled numbers. It started out about 10% and wandered up. These are people generating statistically significant negative alphas. Now the green line shows the number percentage that were generating statistically significant alphas, these masses of the universes. It peaked in the early 90s at about 20%. And by the end of 2011 was under 2, and this is all before taxes. And since taxes are the highest expense of active managers in taxable accounts, it's probably under 1%, or it means you have a 1 in 100 chance after taxes of identifying an active manager who's going to outperform with any statistical significance that would give you confidence it will continue. Now, I don't know about you, but I don't like odds of 100 to 1 against me. The only conclusion we can draw is that even though the absolute skill level of active managers is clearly increasing, it's getting harder and harder to generate alpha because the level of competition is also increasing. We're now going to turn to our 4th theme, that the supply of dollars chasing a shrinking sources of alpha and the competition being tougher is making it, of course, much harder. So my friend and fellow author, Bill Bernstein, did a study looking at a 15-year period. He called the study Skating Where the Puck Was. He looked at the 15 years from 98 to 12 and looked at the return on hedge funds. At the beginning of the period, hedge funds had just about 300 billion of assets, but by the end of the period, it had grown tenfold or something. And today it's about tenfold. I don't remember exactly what it was at the end of the period. So we can see in the beginning period, they had big alphas. Money flows in. Of course, academics had discovered the size and value factors and funds were created. And now you can't claim alpha anymore. And the competition's getting tougher. And the next 5 years, it was gone. And it got much worse over the next period. And now, I won't spend much time here, but you could look at the last 10 years at hedge fund performance, these genius masters of the universe barely outperformed virtually totally riskless 1-year treasuries by 30 basis points, underperformed by wide margins every major equity asset class, and also relatively safe bonds. With that said, it's important to note that we really don't want all these active managers to disappear. And the reason is they provide societal benefits. It's their competition for information that keeps markets highly efficient, both in terms of information and capital allocation. So fortunately, we don't need a lot of active managers to compete. In the 1950s, this will shock you, but the markets were not as efficient as they were today for all the reasons we've gone through, but they were pretty efficient. Studies showed that the average mutual fund underperformed even then, but there was only less than 100 mutual funds, and the markets were pretty efficient. So today there's, I think, something like 10,000 mutual funds, 10,000 hedge funds. You know, we could have 90% of the active world disappear, and we'd probably still have enough competition for information to keep markets efficient. On top of that, those 100 would be the smartest people in the world. So that would also help keep prices efficient. The good news is, because of that, we get to be free riders. We get all of the benefits of active managers keeping the markets efficient, and we don't have to pay any of their costs. So I'm going to ask everybody on this call to please keep this quiet. Don't tell anybody else what I've told you. We need them to have hope springing eternal and keep trying to outperform. So let's wrap up. There are 4 hurdles here for alpha seekers. The pool of alpha has been shrinking. The pool of victims has been shrinking. The competition's getting tougher, and the amount of assets competing for that shrinking pool of alpha is shrinking. Now, while the news on the ability to generate alpha is not heartening for investors who are trying to beat the market, for those investors who are smart enough to recognize that active management is what Charles Ellis called the loser's game, one again that while it's possible to win, the odds of doing so are so poor that it's not prudent to try. The trends are all favorable. Everyone here who's an index type of investor, you're benefiting from the intense competition between providers of these passive systematic funds, because costs are falling sharply and academics are providing us with all of the means to access these unique factors, and we're getting them at low prices. ETFs are highly tax efficient, and there are other funds that are also tax managed as well. So where the trend is actually making it even more difficult for active managers, because the lower cost of passive strategies is pushing more people to become passive, because the hurdles for active managers have gotten bigger because their relative costs are higher. And so I think there's nothing in sight that won't keep this trend continuing. The only thing that I think that might change is that I think we may be now at the tipping point, having seen 10 years of horrific returns to hedge funds. I'm optimistic that enough investors will wake up and recognize hedge funds are a club you don't want to belong to, that amount of money chasing alpha will shrink, and that will alleviate some of that pressure. But the other trends are only going to continue to advantage the passive strategies and make active investing even more of a loser's game. So with that, I'll conclude my portion of the talk and open it up for questions. I see a question here. Some of the people in the U.S. financial competition have real money returns of more than 100% a year. How do you explain that? Well, if you put, let's say, 100,000 people and they threw darts and they picked stocks, you would expect a few to get those kind of returns randomly. Pretty simple. There was a game they used to play, darts against the experts, and they found the darts won just as often or more often than the experts did. That's the problem. You need to understand statistical significance and not think just, and not confuse what is likely a random outcome. And by the way, of course, some of their 100% returns could be not alpha, but taking massive risks. I don't know what they did, but they could have bought deep out of the money options, levered it up, and got lucky and owned Tesla for a short period. That's not an investment strategy. That's gambling and speculating. So. I'm happy to take any other questions. You might want to take yourself off mute.
Okay, can you hear me?
Yep.
So I've been investing probably, I don't know, probably close to as long as you have. And it's been my vocation because since I retired from the Navy, I haven't worked for anybody else. And I have very few mutual funds, but I have probably a few in my IRA. And I look for active managers with long-term returns. I mean, I probably invest more like an institution. I've got a lot of senior securities, preferreds and whatnot. Some with even up to 50% when they were mispriced back in March. But like for instance, a mutual fund I have a Barron's Ron Barron Global Fund, which is a stellar fund, has long-term performance. I've got an Acre Fund. I've got a Federated Fund. And these have long-term, consistently long-term performances. So I don't know if I'm missing what you're talking about, Alfia. So there's another universe of funds that.
So let me address it this way. So all of the evidence shows that past performance has no predictive value whatsoever in terms of future performance. And on top of that, one of the reasons why is that success of active managers contains the seeds of its own destruction, because success means that people like you who believe past performance is a predictor flood money going in. And the great evidence, for example, as soon as Morningstar increases a star rating, cash flows massively increase and vice versa. Now, if anyone could be able to pick mutual funds that outperform, you would think it would be the big institutional investors like pension plans. Unlike you, they hire the most sophisticated institutions to do due diligence and pick the best funds for them. Unlike you, they get to interview personally Ron Barron, spend hours researching. They will talk to him. They'll do dozens of interviews. They will screen his performance record for everything you could think of. And here's what the research shows. The funds, and there are several studies that find exactly the same thing. The funds that these institutions buy underperform the funds that they fire previously. So they hire a manager, they underperform, then they fire them, and they repeat the same process. And then the manager they hire goes on to underperform the very manager they fired. They would have been better off simply owning pure index funds. That's what the research shows. Are there some investors who got lucky, if you will, in my opinion, and ended up owning, say, a Ron Barron fund? Yeah, that's going to happen, just like randomly throwing, someone hits and gets Tesla and it happens to go way up. But there were many people doing exactly what you were doing, and they bought a fund that had exactly or maybe even better performance than Barron's did at that time, and they underperformed. The research shows very clearly that these big institutions who are buying funds based on past performance do not outperform going forward. There's not a single study that finds anything different than that. The problem is that the people who are successful take credit, they think, for their skill in identifying it, and the people who fail blame bad luck and they keep playing. Well, the evidence is much more likely that it was luck when you outperform, not skill, because people doing exactly the same thing with the same resources. I'm just giving you the facts. You can decide what to do with that or not. But I can give you, here's some, there are dozens of examples I've cited in my books. People who outperform for 15 years, or the best fund over an entire decade, and then got slaughtered. Best example I could think of is Bill Miller. Outperformed the S&P, only guy in history to beat the S&P 15 years in a row. The next decade, he was a disaster. The best performing fund in the 70s, I think, was a fund called 44 Wall Street. The next, you wait a decade. It can't be luck. And so you wait until 1980 and you buy this fund. The market went on a tear, and that fund lost 73% over the decade. Sorry, but the evidence is very clear. What you think is a winning strategy simply has not worked for the average investor doing exactly what you're doing.
Well, I think you mischaracterized me. I think that's a non-answer, and you basically recited your lecture with some more information.
Well,
I'm going to retire from this.
okay.
You can't pigeonhole me, and you can't group me in with. I
Larry,
understand statistics.
yeah, Larry, thank you very much for the wonderful presentation. I have a question in lines to what you have been saying. Completely agree with passive indexing.
Yeah.
I have a question regarding what do you think about direct indexing versus the index mutual fund or ETF? And secondly, from asset allocation perspective, what's your opinion about investing in gold and cryptocurrencies like Bitcoin?
You got a whole bunch of questions. So let's say, so direct indexing has some advantages because mutual funds can't pass through losses, and you can harvest losses in direct indexing. On the other hand, ETFs, for example, have virtually no distributions now, are highly tax efficient, and I think I mentioned Schwab's total market fund, 1.5 basis points. I don't know why you would bother there. And the evidence, for example, is if you go through Robinhood, for example, and if they were to build a direct index portfolio, what Robinhood doesn't tell you is they're selling your order flow to some hedge fund that's trading in front of you, and you're getting screwed on every price a little bit. So I would just say, first of all, for IRA type money, there's no advantage at all in direct indexing because it's so cheap to do it through funds. And even for taxable accounts with expense ratio so low, I would not bother unless you had a really large portfolio in the millions of dollars, and then it might pay. But other than that, I think you're better off just owning a broad-based index fund.
Oh.
And by the way, that's certainly even more important if you're going to be in small stocks, because you really have to own thousands of them, and that's not going to happen with direct indexing. They'll sample a portfolio, and you may get lucky or not. The tracking error would be big. So
Okay.
I don't think it's necessary. I think you can just own, like I said, ETF. Gold, I can't think of a really good reason to own gold. It is not an inflation hedge, despite what most people think, except if your horizon is about 100 years. Gold has held up. And when Jesus walked the earth, an ounce of gold bought a good suit of clothes. That's about what it did. And today, that's about what an ounce of gold will buy you. But you got no return for 2,000 years. I don't know why you would want to own an asset that got you no real return if your horizon is like 100 years. Now, if your horizon is maybe 20 years, I'll show you a 23-year period where gold lost 86% of its real value. So that you cannot claim something as an inflation hedge if over a 23-year period, it could lose 86% of its real value. Gold has some benefits. It acts as some hedge and flight to qualities, hyperinflation. So if you want to own a few percent in a portfolio, I wouldn't fight it, but I have never owned gold. I don't recommend owning gold. I'd rather own something with a real return expectation. Cryptocurrencies, I certainly admit I could be wrong here, but I see no logical reason They're pure speculation. This argument that, for example, there's a limited supply of Bitcoin and therefore it could go way up in value, to me is just completely nonsensical. Because while it may be true that there's a limited supply of Bitcoin, there is an unlimited supply of other cryptocurrencies that could be invented. And a basic law of economics is supply and demand determine price. And if you have unlimited supply of something, then the price should go towards zero. So that doesn't mean that 10 years from now, maybe Bitcoin will be trading at $50,000. I could be wrong, but I can tell you it's certainly not an investment, because an investment by definition is something you can look at the cash flows and put a discount rate based on the risk and create and estimate a value. There's no way to do that because there's no cash flows with Bitcoin. And I would argue there's no, of course, cash flows either with gold. So I wouldn't do it, but you know, if you have FOMO, this fear of missing out, take 1 or 2%, go buy Bitcoin, and maybe you'll hit a 10 or 20 bagger or even a 50 bagger. And you'll say, Larry Swedroe was wrong. You know, I said the same thing when I wrote a paper on it on Seeking Alpha in 2017. At the time, I think it was about 10,000 having come down from 20. And then it's now went down to as low as 4, I think, and then bounced all the way back to 20. And now last I looked, it was 18. I think it should be maybe, I don't know, $10 or something, but I could be completely wrong. I freely admit that.
Yeah. Thank you very much, Larry. Really appreciate all your work.
Mm-hmm.
Just a quick question. I remember a few years ago, Warren Buffett made $1 million donation bet against the top hedge funds. Remember that?
Yeah.
And what he did was, and as I recall, made a bet that over a period of time, the S&P 500 would beat those hedge funds.
Yep, 10 years.
And those guys wound up, the hedge funds, the top guys, picked which ones, and they lost, of course.
Yep.
And that $1 million was paid by the hedge funds or whatever the amount was to the charities. And Warren Buffett proved again that he was smarter than the smartest guys. I guess that kind of backs up your theory, right?
Yeah, that's absolutely true. But I'll point this out. Buffett's genius was discovering what I laid out to you decades before the academics. Since around 2008, Buffett has not outperformed any reasonable benchmark whatsoever. If you would look at him compared to, say, a large value index or S&P 500 even, there's no evidence of any alpha, despite the leverage Berkshire has. I wrote up about that. So the market has caught up with him, if you will, and discovered what was his secret sauce. Again, it takes nothing away from what he accomplished. But, Buffett said he was telling everybody in every one of his annual reports, here's what you should do. And guess what? The market eventually figured out Buffett was right. They reverse engineered what he did and found out it wasn't his individual skills. You just bought an index of stocks with those characteristics, you got Buffett-like returns. Now, you didn't have the leverage he had, and you didn't have his ability to write a check to Goldman Sachs for $5 billion when they desperately needed and got a deal, right, that nobody else could have gotten because they wanted his impromptu to give confidence to investors in Goldman Sachs. So that's the story there. Did you have anything else, Scott, you wanted to add?
I was wondering, are you suggesting then that the best thing to do is just buy any old index fund or ETF and do that instead of picking and choosing and researching?
Yeah, well, no, I wouldn't say buy any old ETF or index. I
Okay,
would say that your time is far better spent. Stop analyzing stocks, researching, and there are far better, more important things that will add far more value to your life. I'd much rather spend my time reading books to my grandkids, playing pickleball, which I was doing 2 hours ago with my wife, and those kinds of things, taking a walk in the park,
right.
than
So
doing what the
you
first
still need
call
to
it.
select a fund or an index fund or something, right?
Well, so what you want to do is you want to first decide, and I wrote a book. I would recommend you read Your Complete Guide to a Successful and Secure Retirement. It's, I think, by far the most comprehensive book on retirement. There are other very good books on, Social Security retirement or estate planning, or others are investing for retirement. But there's no book like mine which covers this whole array, including planning a life in retirement, when to take Social Security, elder abuse, teaching your children 529s, HSAs, reverse mortgages. I
Okay,
recruited.
I'm just interested in the investing area.
Right. So there are 7 chapters in that book that will walk you through the things you
Okay,
need to know. You need to identify your unique ability, willingness, and need to take risk. Those things, and I walk through and give questions, about how to help you determine that. Once you determine that, that sets your asset allocation. So how much stocks and how much safe bonds. And then within the safe stock, or within the stock part of the portfolio, you need to decide how much US, how much developed, how much emerging markets. And then within those categories, you want to decide how much exposure I want to large stocks versus small,
right.
value
That's
versus
okay.
growth.
I'm already doing that. Okay, thank you.
Okay, once you have done that, then the best thing to do is you want to look at the funds that give you the most exposure for the least cost to those
Right.
factors.
Understand.
So, and by the way, my book does give you a list of recommended ETFs
Okay.
and mutual funds for each asset category. So you can look in there, and that would be, now you don't necessarily want the cheapest fund. So for example, I'll give you one example. This is a good lesson. Most people think that, say you have 2 small value ETFs, they're both passive, so they're identical. The only thing that matters is the expense. So say you use Vanguard Small Value Fund, and let's say its expense ratio, I think, is about 8 basis points. But it's really not very small. The average market cap might be $3.5 billion. It's not very cheap either. The PEs might be, say, 15. You can find other small value funds with market caps under $1 billion and PEs of 10, and I'd be willing to pay, say, 30, 40, 50 basis points for that fund, because that difference in fees is more than swamped by the higher expected returns from the deeper values, smaller size in the long term. So you have to understand that costs are not the only thing that matter. You get into a bit of complexity.
Right. Pretty much not all that different than shopping for anything, really. You have to evaluate all these different facts.
Yeah, and you have to know what to look for. So what you want to do is, there's a good tool, there's a website, Portfolio Visualizer, you can use. It will tell you, for example, I'll just make this up. Say Vanguard their small value fund might have a 0.5 loading on value, and another fund might have a 0.8. Now, if you think the value factor is going to be a 3% premium, that difference of 0.3 is worth 90 basis points a year. That's helpful information for you to decide. On the size factor, because Vanguard's fund is not really small, it's really a mid cap, it might only have a 0.5 loading on size, and another fund might have a loading of 1. If you think the size premium is, say, 2%, that difference gets you maybe 1% extra return. So I'd be willing to pay something to get that extra return.
Absolutely.
But
yeah, so is that website called Portfolio Visualizer?
yes, www.portfoliovisualizer.com, and you
Okay.
can go there. They also have back tests of historical returns of portfolios. So you'll have to know how to run, it will run the regression for you, but you have to know what factors you're looking for and some other things, but it's
Might
pretty
be a little bit
intuitive.
too technical for me, but thank you.
Yeah,
Thank you.
what you can do, Kathy, is you can look even at something as simple, not as technical as Morningstar, and look at their
Yeah, I look
website,
at those.
and it
Yeah,
will show you PEs and market caps, and then you could see the big differences and
right.
decide without
Understand.
knowing the math, say, all right,
Okay.
one's 20 basis points more, but it looks much more value-y and much smaller. I'm willing to pay 20 basis points. Or you could decide not. That's okay. I'll also add this,
Thank you.
where skill comes
Thank
and
you
where
so
an
much.
advisor can add a lot of
Okay.
value, not only through the things we discussed, but Vanguard's fund owns about 15% of it is REITs. Well, if I own REITs in my portfolio, I don't want REITs in small value. Maybe I'm a real estate investor on the side. I don't want to own REITs in a small value. So you need to know how each fund is constructed to really at a deep level.
Thank you.
You're welcome.
Other questions?
Larry, Matt Rudolph here. Will you talk about some of the robo-advisor platforms? I'm test driving Fidelity Investments at 35 basis points, and I've only done it for 12 months, and I'm in a 50-50 allocation, and I'm pretty impressed. I'm a Fidelity fan. I'm a retired professional money manager, so I'm always looking for a better edge, but I'm also listening to your words of wisdom about doing something else with my life. So I really want to turn off my screen and stop watching the stock market, because I think Wall Street's one of the most dangerous minefields in the history of humankind.
Yeah, well, I'll answer it this way. First of all, I went to an MBA program to train as a security analyst and portfolio manager. And unlike the first questioner, I haven't bought an individual stock in over 25 years, I think now, because I learned that the odds are against you. And I'm trained, and I graduated at the top of my class from one of the top MBA programs in the country. But the evidence is very clear that, yes, it's possible to win that game, but the odds are so poor it's not worth trying. And on top of that, you have to sacrifice the time that I'd rather use reading a book to my grandkids or taking a walk in the park with my wife. I spend zero time analyzing stocks, watching CNBC, reading reports, because that adds nothing to the quality of my life. No one's going to die on their tombstone, say, I generated alpha. I wanted to read you were a good father, good grandparent, good friend. That's far more important, focusing on what I call the big rocks in your life. So every time you're spending time, if it's an avocation for you, like people like to go to the racetrack and get entertainment, you want to take a few percent of your portfolio, I have no problem with that. But I'm just giving you my biases here. As to robos, here's the problem. A robo cannot interview you, cannot know you, can't ask the detailed questions to get to your personality. There's no way a robo in asking questions can learn your tolerance for what's called tracking variance risk, how much international risk you're willing to take. Would you wait out a 10-year period when emerging markets underperform or value underperforms? Buffett, he's not changing his value strategy, and value had underperformed for 10 years until March of this year. And now it's having a tremendous recovery, really mostly since September. but he's waited patiently. That's part of the problem. And you could have two robos, just like you have, great example, two target date funds, the same retirement date, and they'll be entirely different portfolios. So my view is a robo for somebody who isn't sophisticated, would try to do it on their own, is definitely better than nothing, because it'll at least have discipline, it'll do the rebalancing, it'll harvest losses, and it will not cause you maybe to panic and sell in March of this year, or in March of 09, or in March, or in 2000 after 9/11, maybe. But on the other hand, if it gives you the wrong answers and you have the wrong portfolio, then you may panic and sell when you wouldn't have if you had an actual advisor helping you. Now, I would add this. My view is the biggest value of a good advisor is, one, education, helping you choose the right asset allocation in the first place, get the withdrawal strategy right, make sure you withdraw from the right assets in the right order, when to take Social Security, and on and on and on and on, having nothing to do with investing. My firm, we spend probably 10% of the time with clients on investing, and the other 90% on everything else in their life, which adds far more value, I think. So, I think Fidelity is probably okay. Like I said, it's never going to be a bad idea because they tend to use index funds, so you're not paying high fees and stuff. But I think my own view is, and again, maybe I'm biased, I work in an advisory firm, I believe an advisor can add more value. And also there are funds that aren't index funds. In fact, my firm, we're 100% passive, and we don't use any index funds. We think that there are definitely negatives to indexing that can be eliminated or minimized by intelligent design. And therefore, we don't use any index funds. But we do use only systematic funds that do not engage in stock picking and market timing. But they get much bigger exposure than the indices to these factors we want. They patiently trade, importantly, and that saves trading costs as well, and et cetera. So I don't think you can go too wrong with them, but I think you could do better would be my answer.
Do you have a minimum in terms of if somebody's thinking about going with you? Is there a minimum?
My firm doesn't have a minimum asset size. We do have a minimum fee. I believe it's $1,250 a year. This year, we also started a subscription model for those who are, the common term in our world is called Henrys, which are high income, no assets. Yet people like a young doctor got out of med school, he's interning, he's now past that stage. Getting now high income, but he's got no assets, he's got debt, but he needs help with planning, estate planning, insurance, and starting his 401k plan at work and choosing the right assets. So I think that is a $275 a month fee. So it just depends on your assets, under how much assets you have.
Okay, thank you.
You're very
Larry,
welcome.
I just want to thank you for a great presentation and spending part of your evening with us. I know it's late where you are at, and so thank you very much. Do you want to do one more question, or do you?
Sure, I'm happy to take one or two more.
Okay,
Few more
does
minutes
anybody
won't
else?
matter. I'm happy to help. Look, just so everyone, I could have retired 25 years ago. I ran the largest, I was the vice chairman of the second largest, actually at one time, the largest mortgage company in the country. It was sold. I could have retired. I had more money than I ever dreamed of. I was going to go back and teach. I had guest lectured at Stanford and some other places, and I continued to lecture, and colleges used my books as textbooks. But I found friends of mine approached me. They had started this RIA, and they were planners, but they weren't investment people. And I had that academic background. So, boy, this would be great. What a way to teach without the bureaucracy. and I could reach a lot more people. And so I joined that firm. And this is my way of giving back, doing events like this. I don't get paid anything for this. You know, the odds of anyone becoming a client are probably very small. You're all DIY investors, but this is why I do it. It's my way of giving back. Hopefully people learn, read my books, and become better, more informed investors. So,
What's the name of your asset management firm?
it's called Buckingham Strategic Wealth.
Okay.
And is your email is on the website for
You
Buckingham?
can email me at swedroe@buckinghamgroup.com.
Okay, thank you.
By the way, just so everybody knows, in my books, my email address is there. I return every single email. I get emails from people all over the world who I never will meet, never will know, and I answer every single one. I don't go to bed at night till I've returned every email that I have time for. If I don't get to it, I get to it the next morning. So I just did an event for the Money Show. I had like 15 people emailing me on questions, and I answered everyone. Did that just yesterday. So I'm happy to help. It's my way of giving back.
Just a reminder to everyone, this presentation is being recorded. We're going to post it on our website, AAII in a few weeks. And we're going to request Larry's slide deck, and we will post that too when we get that. Any last parting question? One more. I want to respect Larry's time. It's late where he is at. Okay, great. Thank you very much, everyone, for attending. Have a great December, great end of the year, and a great holiday. Thanks again, Larry. It was a great presentation. Really
Yes,
appreciate it.
My pleasure. Glad to help, and good luck to everybody. And if you want to read a book that's non-technical at all, it's the one I'm most proud of, if you can still find it. It was about 13 years ago. I wrote a book called Wise Investing Made Simple. And it really explains how markets really work and set prices using stories and analogies relating to cooking and gardening and movies and sports, and has my favorite story, the big rocks in it at the end. Because you may win the game of active management and the price may have been you lost the far more important game of life. I'd rather win both. And I know by simply being a passive investor, I'm literally guaranteed to outperform the vast majority of individuals and professionals simply by the simple arithmetic that William Sharpe did. And then that gives me a much better chance of winning the game of life, because I'm not spending time that I could be with my grandkids and my wife and my friends, watching CNBC, researching Ron Barron's mutual fund, and et cetera, et cetera.
Great. Thanks again, Larry. Take care. Have a great evening.
Take care,
Thank
everybody.
you very much, Larry, and thank
All right,
you.
and I'll get that. I'll email that paper.
Thank you.
The
Okay,
slide.
thank you
Thanks.
for
Okay.
everyone.
Larry.
Larry.
Bye-bye.
Thank
Thank you.